at home, I will be making a presentation on mid-year acquisition. The question I will solve will involve the preparation of consolidated statement of profit or loss and the consolidated statement of financial position. I will explain the procedures for consolidating the subsidiary that is acquired partway through the year of consolidation. I will solve questions from Kaplan ACCA practice and revision kit. ACCA practice and revision kit. What do you mean by mid-year acquisition? Mid-year acquisition is when the subsidiary is acquired partway through the year of consolidation. When the subsidiary is acquired partway through the year of consolidation, the result of the subsidiary should be consolidated from the date of acquisition. The result of the subsidiary should be consolidated from the date of acquisition. That is, the date on which control is obtained. The date on which control is obtained. That is when you will start consolidating the subsidiary. Note, only part year method should be used. Only part year method should be used in consolidating the statement of profit or loss of the subsidiary. That means you are going to apply time apportionment to the subsidiary result. You are going to apply time apportionment to the result of the subsidiary. That is, you are going to apply time apportionment to the subsidiary financial statement. Time apportionment of the result of the subsidiary in the year of acquisition. So where subsidiary is acquired the pathway through the year of consolidation. I want you to know that it is only the statement of profit or loss that you will apply part year method to. You don't apportion the statement of financial position. It is only the statement of profit or loss that will be apportioned. Time apportionment of the result of the subsidiary in the year of acquisition, it should be assumed that revenue and expenses accrue evenly throughout the year unless otherwise stated. Revenue and expenses accrued evenly during the year. So it is only the statement of profit or loss. Please don't forget. It is the statement of profit or loss that you are going to apply time apportionment to. So now we want to consider the procedures now. Procedures for consolidating the subsidiary that is acquired partway through the year of consolidation. The first step is to draw the group structure. Draw the group structure. That is the first step. You draw the group structure. That is step one. Step two. Step two, identify the date of acquisition. Identify the date of acquisition. Identify the date of acquisition. So you may be having XYZ Limited acquired 70%. And you may be given XYZ Limited acquired 70% of ABC Limited on 1st of April 2020. So this is the date of acquisition of XYZ Limited. You identify the date of acquisition. Step 3. Identify the date of consolidation. Identify the date of consolidation. The date of consolidation is the reporting date of an entity. The reporting date of an entity. So you identify the date of acquisition, then you also identify the date of consolidation. I've told you that the date of consolidation is the reporting date of an entity. The reporting date of an entity is said to be the date of consolidation. Then step 4. Count the number of months from the date of acquisition to the date of consolidation. Count the number of months from the date of acquisition to the date of consolidation. Please, this is very necessary. No, I've told you that from step 2 that you identify the date of acquisition, then step 3 you identify the date of consolidation. You now count the number of months from the date of acquisition to the date of consolidation. Where the number of months from the date of acquisition to the date of consolidation is less than 12 months, that means you are going to apply time apportionment to the consolidated statement to the statement of profit or loss of the subsidiary. Where the number of months from the date of acquisition to the date of consolidation is less than 12 months, you are going to apply time apportionment to the statement of profit or loss of the subsidiary. I told you that unless stated otherwise, that you assume that all items in the subsidiary statement of profit or loss are accrued evenly throughout the year. So for that purpose now, you know the date of acquisition for XYZ, the date in which ABC Limited was acquired is 1st of April. And you may be having the reporting date. I'm telling you that the reporting date is the date of consolidation. Let's assume it is 30th of September. 30th September. So if you want to consolidate the financial statement for 2020 now, let's say the reporting date is 30th September 2020. 30th September 2020. So you are now going to count the number of months from April 2020 to September 2020. You have April, May, June, July, August, September. That making 6 months. April, May, June, July, August, September. That is 6 months. That means the statement of profit or loss of the subsidiary, you are going to apportion it. You are going to apply time apportionment. You are going to have 6 out of 9 months. Out of 12 months, sorry. There are 12 months in a year. So you are going to apply time apportionment to the result of the subsidiary by having 6 months out of 12 months. Then, meaning that anything in the statement of profit or loss of the subsidiary, you are going to prorate it. 6 out of 12. Meaning that for revenue of the subsidiary now, you are going to have 6 over 12. For cost of sales, 6 over 12. For expenses, 6 over 12. Other items in the subsidiary statement of profit or loss will be time apportionment. Will be time apportioned. So everything in the subsidiary statement of profit or loss will be time apportioned. So please take note of that. That is step 4. Step 4, I've told you that you are going to count the number of months from the date of acquisition to the date of consolidation. You count the number of months from the date of acquisition to the date of consolidation. Step 5. Step 5. When the number of months from the date of acquisition to the date of consolidation is less than 12 months, apply time apportionment to the subsidiary statement of profit or loss. When the number of months from the date of acquisition to the date of consolidation when the number of months from the date of acquisition to the date of consolidation is less than 12 months. Apply time apportionment. Apply time apportionment. Apportionment to the subsidiary. Apportionment to the subsidiary statement of profit or loss. Please, I didn't say you are going to apply time apportionment to the statement of financial position of the subsidiary. It is only statement of profit or loss of the subsidiary you are going to apply time apportionment to. Time apportionment should not be applied to the subsidiary's statement of financial position. Now, step 6. Step 6, for the purpose of non-controlling interest. I've told you that it is always necessary to calculate the adjusted profit of the subsidiary. This one is necessary for the purpose of NCI. Adjusted profit of the subsidiary. You only need this for NCI. You only need it for NCI. Adjusted profit of the subsidiary is needed for non-controlling interest calculation. Then, to calculate the adjusted profit of the subsidiary, you have profit of the subsidiary. Relating to post acquisition period. So what do we mean by that? That is, you are going to apply time apportionment to profit of the year of the subsidiary. You just go to the statement of profit or loss of the subsidiary. You pick the figure or the amount of profit of the year of the subsidiary. Then you apply time apportionment to that. So that will give you the profit of the subsidiary relating to post-acquisition period. Then you less extra depreciation relating to post-acquisition period. Less extra depreciation on fair value. Extra depreciation on fair value of the subsidiary net assets. Extra depreciation of fair value of the subsidiary net assets at the date of acquisition. So extra depreciation. Then we also less impairment loss where the policy is fair value. Impairment loss where the policy is fair value. Where the policy is proportionate share of net asset, you won't consider the impairment loss here. You only consider the impairment loss where the policy is fair value. Then we also have provision for unrealized profit. Provision for unrealized profit will also be considered where the subsidiary is the seller. Provision for unrealized profit will be considered where subsidiary is the seller. Subsidiary is the seller. Provision for unrealized profit will be considered where the subsidiary is the seller. After this adjustment, so when you deduct this from profit for the year relating to post-acquisition period, then you get the adjusted profit of the subsidiary. So we have adjusted profit of the subsidiary. this adjusted profit, you now apply NCI percentage to that to get your NCI. Non-controlling interest will be percentage attributable to NCI multiplied by the adjusted profit of the subsidiary. So you now get the amount of NCI that will appear in the consolidated statement of profit or loss. So we are going to take question as work example. This question shall be obtained from ACCA study test, or this question is obtained from ACCA study test by Kaplan. ACCA practice and revision kit by Kaplan. Example. This question is obtained from ACCA materials by Kaplan, practice and revision kit. Premier. On 1st June 20x0, Premier acquired 80% of the equity share capital of Sanford. The consideration consisted of two elements: a share exchange of free shares in Premier for every 5 acquired shares in Sanford, and $800,000 cash. The share issue has not yet been recorded by Premier. At the date of acquisition, shares in Premier had a market value of $5 each. Below are the summarized draft financial statements of both entities. Extract from statement of profit or loss for the year ended 30 September 20x0. We have Premier and Sanford. Everything, all figures are in thousand. We have revenue 92,500 and 45,000. We have cost of sales 70,500 and 36,000. We have gross profit of 22,000 and 9,000. Other expenses, we have 12,000 and 5,100. Profit for the year, we have 10,000 and 3,900. Other comprehensive income, gain on revaluation, we have nil for both entities. Total comprehensive income, we have 10,000 and 3,900. Statement of financial position as at 30 September 20x0. We have for Premier and Sanford assets. We have non-current assets, which include property, plant, and equipment of 25,500 and 13,900. We have investments 1,800 and nil. Current assets 12,500 and 2,400. Total assets 39,800 and 16,300. Equity and liabilities. We have equity shares of $1 each, 12,000 and 5,000 respectively. Other equity reserves at 30th September 20W9, note 4, 500 and nil. Retained earnings, we have 12,300 and 4,500. The total equity is 24,800 and 9,500. Liabilities, we have current liabilities of 15,000 and 6,800. Then we have the total equity and liabilities of 39,800 and 16,300. The following information is relevant. 1. At the date of acquisition, the fair values of Sanford's assets were equal to their carrying amounts, with the exception of its property, This had a fair value of $1.2 million below its carrying amount and had a remaining useful life of 8 years at the date of acquisition. Sanford has not incorporated this in its financial statements. 2. Sales from Sanford to Premier throughout the year ended 30 September 2020 had consistently been $1 million per month. Sanford made a markup on cost of 25% on these sales. Premier had $2 million at cost to Premier of inventory that had been supplied in the post-acquisition period by Sanford as at 30 September 2020. Note 3. Premier had a trade payable balance owing to Sanford of $350,000 as at 30 September 2020. This did not agree with the corresponding receivable in Sanford's books due to a $30,000 payment made to Sanford, which Sanford has not yet recorded. 4. Premier investments include investments in shares which at the date of acquisition were classified as fair value through other comprehensive income. The investments have increased in value by $300,000 during the year. The other equity reserve relates to these investments and is based on their value as at 30 September 2009. There were no acquisition or disposals of any of these investments during the year ended 30 September 2020. Note 5. Premier policy is to value the non-controlling interest at fair value at the date of acquisition deemed to be $3.5 million. Note 6. There has been no impairment of consolidated goodwill. There has been no impairment of consolidated goodwill required. A. Prepare the consolidated statement of profit or loss and other comprehensive income for Premier for the year ended 30 September 2020. B. Prepare the consolidated statement of financial position for Premier as at 30 September 2020. So that is the question. This question is obtained from Practice and Revision Kit by Kaplan, ACCA F7. Solution. I've told you that the first thing is to draw the group structure. You draw the group structure. Of course, only one subsidiary is involved. That means it will be a simple group structure. Premier acquired 80%. You have Premier. Premier is the parent. Acquired 80% of the equity share capital of Sanford. Premier acquired 80% of the equity share capital of Sanford. That is the group structure. Premier acquired 80% of Sanford. Then the next thing, you identify the date of acquisition. Please don't forget this. Anytime the preparation of consolidated statement of profits or loss is required, you have to check the date of acquisition. Then you also compare the date of acquisition with the reporting date. Now, when was this subsidiary acquired? On 1st of June 20x0, Premier acquired 80% of equity share capital of Sanford. The date of acquisition is 1st of June. Then the next thing is to identify the reporting date, the date of consolidation. Extract from statement of profit or loss. Extract from statement of profit or loss for the year ended. The year end of the entity is the reporting date. September 30, 20x0. That is the reporting date, the date of consolidation. Then you have identified the date of acquisition. Then you have equally identified the reporting date. Then you now count the number of months from the date of acquisition to the date of consolidation. Let's count. June is 1 month. July is 2. August 3. September 4. You know this is 20x0. 20x0. June 20x0. And this is September 20x0. You count June, July, August, September. That is 3 months. 3 months relates to post-acquisition period. And I've told you earlier that where an acquisition is during the year, only part year method should be used. Since we have from June to September, we have only 4 months. You are going to apply time apportionment to anything that relates to the subsidiary, anything in the profit or loss. You don't apply time apportionment to statement of financial position. It is only statement of profit or loss that you apply time apportionment. You apply time apportionment to the consolidated statement of profit or loss. You apply time apportionment to that of the subsidiary. You don't apply time apportionment to parent. You only apply time apportionment to that of the subsidiary. Only part year method should be used in consolidating the statement of profit or loss of subsidiary where acquisition is during the year. The date of acquisition is June and the date of consolidation is September. That is only 4 months. That means anything that has to do with the subsidiary, you only need that of 4 months. Only that of 4 months. That is post-acquisition period. Post-acquisition period. That is what you need. Post-acquisition period. You apply time apportionment to the result of the subsidiary operation. You apply time apportionment to the result of the subsidiary operation. Then the first thing, let's have working. Working one, we have revenue, the consolidated revenue. That of the parent, we have revenue of the parent, which is Premier, is 92,500. Premier, 92,500. The subsidiary is Sanford. Sanford. The revenue of Sanford is 45,000. 45,000. I'm talking that you are going to apply time apportionment to the result of the subsidiary. From June to September, that is 4 months, as counted earlier. 4 over 12 times 45,000. You apply time apportionment to the statement of profit or loss of the subsidiary. 4 divided by 12 times 45,000. That will give us 15,000. The revenue of the subsidiary that will be consolidated will be 15,000. You now check your note. Check note. Note 2. Note 2 relates to transfer of inventory. Note 2 relates to the transfer of inventory. Sales from Sanford to Premier throughout the year ended 30 September 20x0 had consistently been 1 million per month. Throughout the year, it is always 1 million. And we only have 4 months that relates to post-acquisition period. That means the sales that you are going to consider now that relate to post-acquisition period will be sales of June, July, August, and September. If the sales is 1 million per month, then intergroup sales, I've told you that intergroup sales will be eliminated. Intergroup sales, which is 1 million for 4 months now, from June to September, which is 4 months. That will give us 4,000, and that is the sales that we appear. That is the intergroup sales. I've told you that intergroup sales should be eliminated. Therefore, the revenue that will be consolidated will be 92,500 plus 15,000 minus 4,000, and that will give us 103,500. 103,500. That is revenue that will appear in the consolidated statements of profit or loss. After revenue, working two, we have cost of sales. Cost of sales. That of the parent. The cost of sales of the parent, which is Premier, is 70,500. Premier cost of sales is 70,500 plus Sanford cost of sales, which is 36,000. Sanford. And I've told you that you are going to apply time apportionment, which is 4 months. Since 4 months relates to post-acquisition period, 4 out of 12 times 36,000. Don't forget, I've told you that the time apportionment will only be applied to the statement of profit or loss. You don't apply time apportionment to the statement of financial position. So 4 over 12 for 36,000, that will give us 12,000. Don't forget, I've told you that intergroup sales, I said it will be deducted from revenue and cost of sales. I believe you will have watched my lectures on consolidated financial statements, the statement of financial position, and the part 1 of consolidated statement of profit or loss, and as well as part 2 of consolidated statement of profit or loss before proceeding to this. Then we have intergroup sales. Intergroup sales or intergroup purchases. Intergroup is 4,000. 4,000. We said it will be deducted from revenue and the cost of sales. Then you also check the note, the additional information. You check if there are transfer of inventory. Okay, of course there are transfer of inventory, and which have been eliminated. You also check if there are portion of that inventory transfer that are still in stock. That means you will need to calculate unrealized profit. And I've told you that unrealized profit will be added to consolidated cost of sales. Don't forget that. Now, that same note 2. Sanford, sales from Sanford to Premier throughout the year ended 30 September 2020 had consistently been 1 million per month. Sanford made a mark up on cost of 25% on this sales. That means a profit of 25% was made. That is markup. So Premier had 2 million at cost to Premier of inventory that had been supplied in post-acquisition period by Sanford as at 30 September 2020. So they still have 2 million in inventory. So 2 million have not been sold to the third party. That means you will need to calculate the unrealized profit. Provision for unrealized profit. 25% markup. So we'll be having 25 over 125 times the 2 million that are still in the inventory of Premier. So we have 25 times 2,000 divided by 125. Then the unrealized profit is 400,000. 400. I've told you that the unrealized profit will be eliminated. Let's check note 3. Note 3. Premier had a trade payable balance owing to Sanford of 350,000 as at 30 September 2020. A trade payable is a liability. So that doesn't have anything to do with the statement of profit or loss. So we leave that note 3. Note 4. Premier investments include investments in shares which at the date of acquisition were classified as fair value through other comprehensive income. You were told that this one should be classified as fair value through other comprehensive income. So we have not read the other comprehensive income. So note, okay, the other equity reserves relates to this investment and is based on the value as at 30 September 20 W9. So that will affect the other comprehensive income. Okay, so what we are going to do, this note 5 is also the policy, the parent company policy as to the valuation of NCI. So it doesn't have anything to do with the statement of profit or loss yet. At the date of acquisition, the fair values of Sanford assets were equal to their carrying amounts with the exception of its property. This had a fair value of 1.2 million below its carrying amount. So this is fair value deficit. The value of the PPE or the property has fallen now. The value of the property has fell. Since the property value has reduced, that means the depreciation calculated on the previous carrying amount was overstated. The depreciation was in excess. There was excess depreciation. So since the depreciation was overstated as a result of the reduction in the value of the properties, so we are going to deduct the amount of excess depreciation. So we have excess depreciation now. So you deduct it. And the fair value is 1.2 million. And you were told 1.2 million below its carrying amount and had a remaining useful life of 8 years. It had a remaining life of 8 years. Then the consolidation period, post-acquisition period, is 4 months out of 12 months in a year. So the amount of depreciation now that will be deducted will be 1,200 divided by 8 times 4 divided by 12, and that will give us 50. So that is the excess depreciation you are going to deduct now. So you have 70,500 plus 12,000 minus 4,000 plus 400 minus 50. The value of cost of sales that will appear in the consolidated statement of profit or loss will be 78,850. 78,850. Let's prepare for Premier Group. Premier Group. Consolidated statement of profit or loss for the year ended. September 20x0. 20x0. The first item should be revenue as calculated in working 1. Revenue we have revenue working 1, and our revenue is 103,500. That is working 1. 103,500. After revenue, the next thing is cost of sales. Cost of sales, that is working 2. From our working 2, our cost of sales is 78,850. 78,850. After deducting cost of sales from revenue, you arrive at the gross profit. Gross profit. Gross profit. So subtract 78,850 from 103,500. Then our gross profit will be 24,650. 24,650. After gross profit, the next thing is other expenses. Other expenses. That of the parent, that is that of the premier, is 12,000, and that of Sanford 5,100. You have 12,000 plus, you are going to apply time apportionment to that of the Sanford times 5,100. 4 months. Since 4 months relates to post acquisition period. So 5,100 times 4 divided by 12, then this will be 1,700. If you add it to 12,000, it will be 13,700. 13,700. After other expenses, the next item is profit for the year. Profit for the year. There is no tax. So 24,650 minus 13,700. Then we have 10,950. That is the profit for the year. 10,950. After profit for the year, the next item is other comprehensive income. Other comprehensive income. As part of our other comprehensive income, we have from note 4, we have the gain on property revaluation, gain on fair value of investment that is measured through other comprehensive income. That is note 4. Premier had, note 4. Premier investments include investments in shares which at the date of acquisition were classified as fair value through other comprehensive income. Fair value through other comprehensive income. The investment have increased in value by $300,000 during the year. The other equity reserves relates to this investment and is based on their value as at 30 September 2009. There were no acquisition or disposal of any of these investments during the year ended 30 September 2010. Now, since there are fair value increase, the value of the investment has increased by 300,000. Then that means there will be a gain. There is a gain on investment that is measured on fair value through other comprehensive income. Gain on fair value through other comprehensive income investment, and that gain is 300,000. 300,000. If you add the 300,000 to 10,950, 10,950 plus 300,000, and that will give us 11,250. 11,250. That 11,250 represents total comprehensive income. Total comprehensive income for the year is 11,250. Then this profit for the year, you are going to share it between the parent company and the non-controlling interest. And I have told you that for the purpose of NCI, you will need to calculate the adjusted post-acquisition profit of the subsidiary. Let's compute that working 3. Working 3. Adjusted post acquisition profit of the subsidiary. Adjusted post acquisition profit of the subsidiary. So you now have profit for the year. Profit for the year relating to post acquisition period. The one relating to post acquisition period is what you need, and the profit for the year of subsidiary is 3.9 million. Remember, 3.9 million is the profit for the year. Post acquisition period, I'm adding K because we have hit 3 zeros at the top, which is 1,000. So the one relating to post acquisition period is 4 months. You are going to apply time apportionment to that, and that will be 3,900 times 4 divided by 12. Then you have 1,300. 1,300. So if you go through the note, we have note 2. Note 2 is intergroup sales. Note 2 is intergroup sales. I've told you that the first question you should ask yourself is that who is the seller? You first of all determine the seller. So I've told you that the unrealized profit will need to be adjusted here. That is in the adjusted profit where subsidiary is the seller. Where parent is the seller, you don't need to adjust the unrealized profit. Now, if you read through that, sales from Sanford to Premier throughout the year. Sales from Sanford. Sanford is the seller. Sanford is the seller. Therefore, you will need to calculate the unrealized profit. You will need to adjust for that. Provision for unrealized profit. Where parent is the seller, you don't need that. No, we calculated it on 2 million. A markup of 25%. So we had 25 over 125 times 2 million. So the unrealized profit, 2 million times 25 divided by 125. And we have 400. 400. The unrealized profit will be eliminated since it has been recognized. Then excess depreciation on fair value decrease. Excess depreciation on fair value decrease. The depreciation previously recognized was in excess. So that means the profit of the subsidiary has been affected, has been reduced by the amount of excess depreciation. Therefore, you are going to add it. So, if you add that, then you have the adjusted profit will be 1,300 minus 400 plus 50. Then you have 950. Remember what parent acquired in subsidiary is 80%. Therefore, NCI, not controlling interest, will be 20%. 20% of 950,000. 20% of 950,000, that will be the amount of NCI that will appear in the statement of profit or loss. So we now have profit for the year. Profit for the year attributable to one, parent. The second one, non-controlling interest. And the total profit for the year is 10,950. 10,950. That is the profit for the year. Out of this 10,950, 190 relates to the non-controlling interest. Out of 10,950, 190 relates to the non-controlling interest. 10,950. The NCI is 190. If you insert that 190 as NCI, then the balancing figure will be the one that is attributable to the parent, balancing figure, and that will be 10,950 minus 190. 10,950 minus 190, and that will give us 10,760. 10,750. That is the profit for the year attributable to the parent company and the one attributable to the non-controlling interest. The next thing is total comprehensive income attributable to total comprehensive income. Total comprehensive income attributable to parent and the non-controlling interest. The one attributable to the parent company and the one attributable to the non-controlling interest. So, the one attributable to the non-controlling interest is 190, being the NCI as calculated above. The one attributable to the parent company will be the profit for the year of the parent, 10,760. 10,760 plus the 300, which is the other comprehensive income there. So 190, that is the NCI. Then you were also told that premier investment, that is from note 4, that premier investments include investment in shares which at the date of acquisition were classified as fair value through other comprehensive income. Premier is the owner of that fair value increase. You were told the investment have increased in value by 300,000. So since Premier is the owner of that fair value increase, you are going to add that fair value increase of 300,000 to the 10,760 profit for the year attributable to the parent. But if NCI were the owner, you are going to share it between the parent and NCI. That means NCI will receive a share of it, which will be added to 190. But in this case, Premier, the parent, is the owner. So you add the 300 to 10,760, then you have 11,060. 11,060. So when you add 11,060 to 190, then you have 11,250. That is total comprehensive income. Total comprehensive income for the year. So which must agree with this 11,250 you have as the total comprehensive income for the year. That is all about the statement of profit or loss. Then we want to prepare the statement of financial position. Statement of financial position. For the purpose of the consolidated statement of financial position, we are going to have the summary of the subsidiary net assets. Summary of the subsidiary net asset, and subsidiary is Sanford's. Summary of Sanford's net assets. So that is for the purpose of the consolidated statement of financial position. Then you have post acquisition. You have date of acquisition. You have date of consolidation or the reporting date. I've told you that the net assets are the equity. I've told you that net assets are the equity. You go to the equity section of the statement of financial position. Equity section of the statement of financial position. Then you have equity shares. That of Sanford is 5,000. Equity shares of 5,000. Equity shares. That of Sanford is 5,000. Then you also have the retained earnings. Retained earnings of Sanford is 4,500. There are no other equity reserves for Sanford. So retained earnings of Sanford is 4,500. Retained earnings of 4,500. You were told from note 1 that at the date of acquisition, the fair values of Sanford assets were equal to their carrying amounts, with the exception of its property. This had a fair value of 1.2 million. It had a fair value of 1.2 million below its carrying amount and had a remaining useful life of 8 years. That means there is a fair value deficit. Fair value, I've told you that you have to put fair value adjustment, fair value deficit or decrease. Fair value decrease, you have fair value decrease of 1.2 million. Since it is a decrease, you are going to subtract it. So it is occurring at the date of our acquisition. That is why you were to at the date of acquisition. That means you are going to adjust that fair value decrease at the date of acquisition. So since it is a deficit, you subtract it. If it is a surplus, you add it. So you don't have it in post-acquisition period. The equity shares, there are no further acquisition, no further issue of shares since acquisition. So the equity shares at the date of acquisition will still remain as 5,000. Now, if you look at the question from A to Z, you will not see pre-acquisition profits anywhere. No pre-acquisition profit. So you have to determine that now. I've told you that there are two ways of calculating the pre-acquisition profit. Pre-acquisition profit. I gave you two formats. If you watch my lectures on consolidated statement of financial position, where we have acquisition during the year, I said there are two ways of calculating the pre-acquisition profit. I said you can put the accumulated retained earnings as per the statement of financial position. I said you have accumulated retained earnings as per the statement of financial position. And you were given the retained earnings of the subsidiary. The one you have in the statement of financial position is given to be 4,500. It's given to be 4,500. From this 4,500, you less profit of the year relating to post-acquisition. Less post-acquisition profit. Post-acquisition profit. I want you to know that the profit for the year in the statement of profit or loss also includes this 3,900. The retained earnings of 4,500 in the statement of financial position also include the profit for the year. So now the one that relates to post-acquisition period, you know the post-acquisition period is 4 months. So if you calculate the profit of 4 months, 4 over 12 of 3,900. 3,900. 4 over 12 of that. 3,900 times 4 divided by 12. Then that will give us 1,300. The 1,300 is the post-acquisition profit. If you subtract post-acquisition profit from the accumulated profit of the subsidiary, if you subtract 1,300 from the accumulated profit of the subsidiary as per the statement of financial position, then you have 3,200. This 3,200 is the pre-acquisition profit. That is method 1. Another method I've equally explained. I said you can start with method 2. I said you can start with accumulated retained earnings as per the statement of financial position. As per statement of financial position, which is 4,500. From that, you less profit for the year. Profit for the year of subsidiary. The profit for the year of subsidiary is 3,900. Profit for the year 3,900. You subtract that 3,900. If you subtract the 3,900 from 4,500, 4,500 minus 3,900, then you have 600. That 600 represents profit for prior period. Profit for prior period. Then, you know, the profit for the year of 3,900, part of it relates to the pre-acquisition period, while 4 months of it relate to post-acquisition period. See, this is the profit of 12 months. And out of these 12 months, only 4 months relate to the post-acquisition period. That means 8 months will relate to pre-acquisition period. So we now add profit for the year relating to the pre-acquisition period. To the pre-acquisition period. Pre-acquisition period is 8 months. In post is 12. 8 plus 12 is 8 plus 4 is 12 months. In post acquisition period, I mean, if it is 4 months, pre will be 12 months. Will be 8 months. From 12 months, you subtract post of 4, then you'll be left with 8 months. That means 8 months is the pre-acquisition period. 8 over 12 of that 3,900. The 3,900, don't forget, is the profit for the year. 3,900 is the profit for the year. You want to calculate the pre-acquisition profit from the 3,900. 3,900 times 8 divided by 12, and that will give us 2,600. If you add the 2,600 to the profit of the prior period of 600, then you have 3,200. That is the pre-acquisition profit. Then the pre-acquisition profit of the subsidiary is 3,200. Therefore, if you subtract 3,200 from the accumulated profit of the subsidiary as per the statement of financial position, then you will have the post-acquisition profit of 1,300. And don't forget, this fair value decrease led to excess depreciation. Excess depreciation on the fair value increase will be 1,200 on fair value decrease. This is a fair value decrease. That means the carrying amount is below, the fair value of 1.2 million below its carrying amount. So now post-acquisition period is 4 months. So we have, that gives us 50. 1,200 divided by 8 times 4 divided by 12. We had 50,000. So that depreciation. So since it is excess depreciation, that means the depreciation that have been charged before is too much. So we are adding it to the profit of the subsidiary in order to increase it. So the net asset now, we have 5,000 plus 4,500, that is 9,500 minus 1,200. Then we have 8,300. Then the one at the date of acquisition is 5,000 plus 3,200, that is 8,200 minus 1,200. The net asset at the date of acquisition is 7,000. Then the post-acquisition profit is 1,350. That is the post-acquisition profit. So no impairment, and there are no further notes that will affect the profit or loss. So, okay, we have unrealized profit. The seller is subsidiary, so we need to adjust that in post-acquisition period. Sorry, the seller is the subsidiary. Subsidiary is the seller. If parent were the seller, then you will not need to adjust the unrealized profit. Provision for unrealized profit, which is 25/125 times 2,000, and that is 400. 400. So the adjusted profit of the subsidiary. So we have 1,350 minus 400. Then we have 950, which is also the same as the profit for the adjusted post-acquisition profit of the year of the subsidiary, which we have used in calculating NCI for the consolidated statement of profit or loss purpose. So now we want to compute goodwill on acquisition of the subsidiary, working 6. So working 5 is calculation of the pre-acquisition profit. We want to compute the goodwill on acquisition of Sanford. Acquisition of Sanford. Now, you share the information where you share the question where you have information about the consideration transfer. Consideration transfer. On 1st June 2020, Premier acquired 80%. Premier acquired 80% of the equity share capital of Sanford. The consideration consisted of 2 elements: a share exchange of 3 shares. 3 shares in Premier for every 5 acquired shares in Sanford, and 800,000 cash. So we have consideration transfer. Consideration transfer. We have cash consideration of 800,000. Then we also have share exchange. Share consideration or share exchange. You were told a share exchange of 3 shares in Premier for every 5 acquired shares. Know what Premier acquired in Sanford is 80%. So how much will be the shares acquired now? You have 80% of Sanford shares. We have shared the equity shares of Sanford. Equity shares of $1 each, which is 5,000. 5,000 divided by 1 will still be 5,000. 80% of 5,000, that will give you 4,000 shares. The number of shares acquired by Premier in Sanford is 4,000 shares. That is 80% of 5,000. Then, and a share exchange of 3 shares in Sanford for every 5 acquired. They will give the shareholders of Sanford 3 shares for 5 shares. In place of 5, if they acquire 5 shares, they will give them 3 shares in return. Then you will also need the market price of the parent to value it. The share exchange has not yet been recorded by Premier. At the date of acquisition, shares in Premier had a market value of $5 each, multiplied by $5. So that will give you the consideration for the shares acquisition. Calculate 80% of 5,000. That will give you 4,000 shares acquired, times 3 divided by 5. Then that means the shareholders of Sanford will be given 2,400 shares in place of 2,400 shares. If you calculate this, 2,400 in place of 4,000 shares acquired, times the market price of the parent, which is 5. Then you have 12,000. 12,000. So 12,000. The amount of consideration so far is 12,800. 12,800. That is 800 plus 12,000. That will give us 12,800. The next thing is the fair value of non-controlling interest. You are given fair value of non-controlling interest. Non-controlling interest. Note 5. Note 5. Premier policy is to value the non-controlling interest at fair value at the date of acquisition, deemed to be $3.5 million. You are given the fair value of non-controlling interest to be $3.5 million. So if you add it to 12.8 million, 12.8 plus 3.5, that will give us $16.3 million. $16.3 million. Then you now less the fair value of net assets, less the fair value of net assets at the date of acquisition. Fair value of net assets at the date of acquisition, and that is given to be $7 million. Date of acquisition, $7 million. So if you less the $7 million from 16.3, then you have $9.3 million. $9.3 million. In note 6 of the question, you have been told that there has been no impairment of consolidated goodwill. There has been no impairment of consolidated goodwill. That means this is the amount of goodwill that will appear in the consolidated statement of financial position. Goodwill that will appear in the consolidated statement of financial position. Then note 7. Note 7. Now let's have the property, plant and equipment. Property, plant and equipment. Property, plant and equipment. And it's 12.5 million. You are given property, plant and equipment, or 12.5 million for Premier and 13.9 million for Sanford. Property, plant and equipment. Working 7. Working 7. Property, plant and equipment. That of Premier, and we also have for Sanford. Premier and Sanford. For Premier, we have 12.5 million, and that of Sanford you have 13.9 million. 12.5 and 13.9. 25.5 million. You have 25.5 million. Then you have 13.9 million. That is the property, plant and equipment. Property, plant and equipment. That of Sanford is 13.9 million, and that of Premier is 25.5 million. Then in note 1, you were told that at the date of acquisition, the fair values of Sanford assets were equal to their carrying amount, with the exception of its properties. This had a fair value of 1.2 million below its carrying amount. So meaning that there is a fair value deficit. Fair value deficit. Since it is below the carrying amount, then you have minus 1.2 million. You let the fair value deficit since it is below the carrying amount. Then, and you were told, and had a remaining useful life of 8 years at the date of acquisition. And had a remaining life of 8 years at the date of acquisition. Sanford had not incorporated this in his financial statement. So there is asset depreciation which had been calculated earlier. Excess depreciation, which had been calculated earlier, and we had 50,000. 50,000. That is the excess depreciation. The amount of excess depreciation will be added. Excess depreciation. Don't forget, we had the fair value deficit is 1.2 million divided by the remaining life of 8 years, and you apply time apportionment since the post-acquisition period is just 4 months. So we have 4/12, and that is how we got 50,000. That 50,000 will be added. We are going to add the excess depreciation since the value, the amount now, the value of the asset has fell. Since it has fell in value, the value has reduced. That is why we are going to deduct the amount of the excess depreciation. We are going to add the excess depreciation. So we now have 25.5 plus 13.9 minus, this is 13.9 million minus 1.2 plus the asset depreciation of 50 million. Then you have 38,250. 38,250. That is the amount of property, plant and equipment that will appear in the consolidated statement of financial position. Consolidated statement of financial position. Current assets. Current assets of Premier is 12,500, and that of Sanford is 2,400. Let's have working 8. Working 8. Current assets. We have for Premier 12,500. Sanford 2,400. Now let's go through the note. Note 2. We have sales from Sanford to Premier. Sales from Sanford to Premier throughout the year ended 30th September 20x0 had consistently been 1 million per month. Sanford made a markup on cost of 25% on these sales. Premier had 2 million as cost to Premier of inventory that had been supplied in the post-acquisition period by Sanford as at 30 September 20x0. Now, these sales will be used to calculate the unrealized profit. So you calculate the unrealized profit, provision for unrealized profit, which is 25% markup out of, I've told you that when you are converting from markup to margin, you add the numerator to denominator. You know you have 25%, which is 25 over 100. If you add the numerator, which is 25 to 100, then you have 125. Multiplied by, I've told you that the unrealized profit should be calculated on the unsold items of inventory, which is 2 million. So you multiply by $2 million. So we have 25 divided by 125 times 2 million, and that will give us 400. That will give us 400. So we have minus 400. That is the unrealized profit. Now, note 3. Note 3. We have Premier had a trade payable balance owing to Sanford of $350,000 as at 30 September 20x0. This did not agree with the corresponding receivable in Sanford's books due to a $30,000 payment made to Sanford, which Sanford has not yet recorded. So we have a payment of $30,000 which was in transit. So that is check in transit or cash in transit. Cash in transit of $30,000. So that will be added to consolidated cash. Then this is current asset. Then you are going to eliminate the intergroup receivables. Intergroup receivables. We are going to remove it from the current asset. Back to note 3. Premier had a trade payable balance owing to Sanford of $350,000. This is what Premier has as payable. And you know what Premier is going to disclose as payable will reduce because Premier has paid $30,000 from what he was owing. So if you subtract $30,000 from the entire receivable, it is then that you have the $350,000. That means the receivable should be $380,000. This receivable had been reduced from $380,000 to $350,000 because $30,000 had been paid by Premier. Payment made to Sanford, which Sanford has not yet recorded. So meaning that the receivables now will be the sum of $350,000 plus the $30,000 which have been remitted. Then that means the intergroup receivable will be $380,000. $380,000. Note 4 is about investment. Investment doesn't affect our current assets. Note 5 is about the policy, and the note 6 is about the impairment loss. So you cast. So we have 12,500 plus 2,400 minus 400 plus 30 minus 380. Then you have 14,150. 14,150. That is the total of our current assets. Then in that same note, if you look at the note 6, Premier investments include investments in shares which at the date of acquisition were classified as fair value through other comprehensive income. The investment have increased in value by $300,000 during the year. The other equity reserves relate to this investment and is based on their value as at 30 September 2009. There were no acquisition or disposal of any of this investment during the year ended 30 September 20x0. So that is the note on investment. So now let's have Premier Group, Premier Group, Consolidated statement of financial position as at 30th of September 20x0. As at 30th of September 20x0. So you start with assets. The first asset we have is non-current assets. Non-current assets Our non-current asset from working 7. Working 7, we have property, plant and equipment. And we got 38,250. 38,250. That is the property, plant and equipment. That is working 7. That is 38,250. 38,250. Then we have Goodwill, working 6. Goodwill, and we got 9,300. 9,300. That is our Goodwill. 9,300. So Goodwill, that is from working 6. 9,300. Then we also have investments. Investment, we have 1,800 in the statement of financial position. On 1st June 20X0, Premier acquired 80% of the equity shares of Sanford. The consideration consisted of 2 elements: a share exchange of 3 shares in Premier for every 5 acquired shares in Sanford, and 800,000 cash. The share issue has not yet been recorded by Premier. If you look at the consideration, you were given share consideration or share exchange, and then you were given cash consideration. And you were told that the share issue, that is share exchange, has not yet been recorded by Premier. That means the only consideration that has been recorded so far is the cash consideration of 800,000. So this investment of 1,800 comprises of cash consideration of 800,000 and other investments. So you are going to have working 9. Let's have other investment. Working 9. Other investments. The total value of the investment as per the statement of financial position is 1,800. That is gross investment or total investment as per statement of financial position, which is 1,800. Of this 1,800, you have cash consideration of 800,000. Cash consideration of 800,000. So if you remove the cash consideration, if you remove that, then that means the remaining 1,000 relates to other investment. The remaining 1,000 relates to other investment. Then from the note, we have additional information on the investment. We have note on the investment. So note 4. Premier investments includes investments in shares which at the date of acquisition were classified as fair value through other comprehensive income. So the investment was classified as fair value through other comprehensive income. The investment have increased in value by $300,000 during the year. The equity reserves relate to these investments and is based on their value as at 30 September 2009. So that means there is fair value increase on the investment. Fair value increase on investment, which is 300,000. So if you add the 300, 18 minus 800, you'll be left with 1,000 plus 300. That means the other investment will be 1,300. This is the amount that will be reported as other investment in the consolidated statement of financial position. So we can now have other investments in our consolidated statements of financial position. That is working 9. Working 9. Our other investment is 1,300. 1,300. That is other investment. So you can, if you record that, then the total of our non-current assets, we have 38,250. 38,250 plus 9,300 plus 1,300. Then you have the total of non-current assets. It is 48,850. The total of our non-current assets is 48,850. After non-current assets, the next thing should be current assets. Current assets. Then if you check our working 8, current assets, the total of our current assets is 14,150. 14,150. So that is working 8. 14,150. Then if you sum it up, plus 14,150, the total of our asset is 63,000. 63,000. That is total assets. Total assets is 63,000. The next section of the statement of financial position will be equity and liabilities. Equity and liabilities. That is the next section of our consolidated statement of financial position. Equity and liability. We have equity shares of $1 each. This is the par value of the company's share. The par value of the company's share is $1. Parent has $12 million shares, while subsidiary has $5 million shares. So what of shares? So in note 1, on 1st of June 2020, Premier acquired 80% of the equity share of Sanford. The shares acquired by the parent is 80%. Remember, the subsidiary share is 5 million, out of which the parent company acquired 80 shares. No, the par value of subsidiary is $1. So $1, 5 million divided by 1, that will still be 5 million shares. So number of shares of subsidiary, working 10. Number of shares of subsidiary, which is 5 million divided by $1, which will be $5 million shares, worth of shares divided by $1, and that will give us 5 million shares. So number of shares acquired by parent. Acquired by parent. By parent. So parent acquired 80% of subsidiary share, which is 5 million shares, and that will be 4 million shares. That is the number of shares acquired by the parent, 4 million shares. Now, the consideration consisted of 2 elements. A share exchange of 3 shares in premium for every 5 acquired shares in Sanford. Now, how many shares will parent give to the shareholders of the subsidiary in exchange for the shares acquired? Number of shares shares exchange now. Shares exchange. Remember the parent acquired 4 million shares. 4 million times 3 shares in Premier. Share exchange now. Share exchange of 3 shares in Premier for every 5 acquired. 3, 4, 5. And that will give us 4 million times 3 divided by 5, and that will give us 2.4 million shares. Number of shares in exchange is 2.4 million shares, meaning that the parent company will give the shareholders of the subsidiary 2.4 million shares in exchange for 4 million shares acquired plus 800,000 cash. So now, and remember, the share issue has not yet been recorded by Premier. At the date of acquisition, shares in Premier had a market value of $5 each. This is the market value of the parent. So now, value of shares exchange now. You multiply the number of shares exchange of 2.4 by the market value of the parent, and that will give us 2.4 times 5, and that will give us $12 million. $12 million. That is the value of shares exchange. That is the consideration transferred. This consideration on share exchange will be divided into 2. Share exchange of $12 million will be divided into 2. The par value of it will go to share capital, while the premium on it will go to share premium. Remember, the market value of the parent is $5, and the par value of the parent is $1. So that means the par value, which is $1, times, so this one will not have dollar value. Okay, yes, it's for value. Yes, this 12 million, we want to divide it into 2. The par value multiply the par value, which is $1, times number of shares acquired in exchange, which is 2.4. So, and that will give us $2.4 million. This $2.4 million will be added to the share capital of the parent company for the purpose of consolidation. What is the difference between the market value, which is $5, and the par value of $1? The market value is $5 and the par value is $1. The difference is $4. Multiplied by the number of shares acquired in exchange, which is 2.4 million shares. Number of shares exchange is 2.4. So 5 minus 1 will give us 4. 4 times 2.4, and that will give us $9.6 million. This $9.6 million will be added to the share premium for the purpose of consolidation. If you add the 9.6 million and 2.4 million, it will give us the 12 million. 9.6 plus 2.4, it will give us the 12 million. So, I've told you that this 2.4 will be added to the share capital of the parent for consolidation purpose. Now, the equity shares now, equity shares of the parent now, the equity shares, that will appear in the consolidated statement of financial position. That of the parent is 12 million. The parent is Premier, which is 12 million. You add the par value of share consideration or share exchange. The par value of share consideration or share exchange, which is 2.4 million. If you add the 2.4 million to 12 million, then you have 14.4 million. That is the amount that will appear as equity shares in the consolidated statement of financial position. Equity shares, which is 14.4 million. 14 9.4 million. After equity share, the next item should be share premium. The share premium. Share premium. There is no existing share premium in the consolidated statement of financial position. So the amount of share premium now that will appear in the consolidated statement of financial position will be share premium on the share consideration or share exchange. This is working 10. Working 10. The premium, it will be the premium on share exchange or share consideration of 9.6 million. The premium of 9.6 million. So that will be added. So 9.6 million. Then the next item is other equity reserves. Other equity reserves, that is at 30th September 20W9. And you are given note 4, which is $500,000. That of the parent, but that of the subsidiary is nil. And you are told it will be found in the note 4. Note 4. Now let's go to note 4. Note 4. Premier investments include investments in shares which at the date of acquisition were classified as fair value through other comprehensive income. The investment have increased in value by $300,000 during the year. The other equity reserves relate to this investment and is based on their value as at 30 September 20W9. There were no acquisition or disposal of any of these investments during the year ended 30 September 20X0. Now, working 11. So now let's have investment, other equity reserves. Other equity reserves. That is working 11. That of the parent, which is Premier. In the statement of financial position of Premier, you have 500,000. Then we also have, you were told it increased in value by 300,000. Gain on investment. Gain on investment, which was measured at fair value through other comprehensive income. The gain of $300,000. So you add it. Then the investment that will appear in the consolidated statement of financial position will be $800,000. $800,000. Other equity reserves is 800,000. That is working 11. Other equity reserves. That is working 11. Which is 800,000. Then the next item is retained earnings. That is working 12. Working 12. We have retained earnings. Retained earnings. So we have that of the parent, Premier. Retained earnings of the parent is 12,300. 12,300. 12,300. Then we now have parent share of the adjusted post-acquisition profit of the subsidiary, which has been calculated to be 950 in our working for. The summary of subsidiary net assets. Summary of Sanford's net assets. So we now have Premier Premier share of adjusted post acquisition retained earnings of the subsidiary, that is Sanford. The percentage of shares acquired is 80%. 80% of 950. 80% of 950, which is the adjusted post acquisition profit. 80% of 950,000, and that will be 950 times 0.80 times 0.8. That will give us 760. If you add the 760 to 12,300, if you add it to 12,300, it will give us 13,060. That is the amount of retained earnings that will appear in the consolidated statement of financial position. So we have retained earnings. That is working 12, and it is 13,060. 13,060 as calculated. 13,060. Then you now sum up the equity section. You want to get the amount of equity attributable to the parent. Equity attributable to the parent will be 14,400 plus 9,600 plus 800 plus 13,060. Then equity attributable to the owners, that is the parent, is 37,860. 37,860. So that is the amount of equity attributable to the owner, that is to the parent. So we have 37,860. Then to complete our equity, you have the non-controlling interest. Non-controlling interest. NCI, let's have that to be working 13. Non-controlling interest on acquisition. Non-controlling interest. That is working 13. So let's have working 13, which is our non-controlling interest. Working 13. Non-controlling interest. So you start with the NCI at acquisition of the subsidiary. Then you check your note 5. Premier policy is to value the non-controlling interest at fair value at the date of acquisition, deemed to be $3.5 million. So we now have fair value of non-controlling interest at acquisition, and that is $3.5 million. That is in note 5. Then followed by NCI, share of adjusted post acquisition retained earnings. Retained earnings of subsidiary, that is Sanford. Remember, what parent acquired in Sanford is 80%. That means the remaining 20% will be attributable to non-controlling interest. 20% of the adjusted profit, post-acquisition profit. Adjusted post-acquisition profit of subsidiary is 950. 20% of 950,000. 20% of 950,000, and that will give us 190. If you add the 190 to 3,500, then the NCI will be total 3,690. That is the amount of non-controlling interest that will appear in the consolidated statement of financial position. 3,690. 3,690. So if you add it to 37,860, 60. Then the total equity will be 41,550. That is the total equity. Total equity. After equity, the next section will be liability. The next section will be the liabilities. We have liabilities. Liabilities. As part of our liabilities, we have current liabilities. Current liabilities. Let's have working 14. Working 14. Current liabilities. We have that of Premier, 15,000. Sanford, 6,800. Premier, 15,000. Sanford, 6,800. Then in note 3, you were told that Premier had a trade payable balance owing to Sanford of $350,000 as at 30 September 2020. This did not agree with the corresponding receivable in Sanford's book due to a $30,000 payment made to Sanford, which Sanford has not yet recorded. So you were told that Premier had a trade payable balance owing to Sanford of $350,000. Remember, trade payable is part of current liabilities. So that means since this $350,000 is an intergroup payable, so you are going to eliminate that. Intergroup payable of $350,000 will be eliminated. So the current liability now will be 15,000 plus 6,800 minus 350. Then you have 21,450. 21,450. Then your current liabilities now working 14. You have 21,450. If you add it to your current asset and your total equity of 41,550, then the total equity and liabilities will be 63,000. Total equity and liabilities. Total equity and liabilities. So this total equity and liabilities must agree with the total assets of 63,000. It must agree with the total assets of